wesleygospel.com. This is wesleygospel.com. And today I'd like to talk about capital preservation. Um, there's not a lot, at least in the investment books I've looked at so far, there's not a lot that's said about this subject. And I wonder why. Because capital preservation is about not investing money. Um, it's about holding it and keeping it to yourself um, when there's hard times coming along, whether it's a personal financial emergency you're going through, like job loss or sudden car repairs, sudden medical bills. Um, and usually that's to be addressed by the emergency fund, which is a form of capital preservation. But then there's also economic recessions, like we're going through now in 2022, in the past 2 years, really. So we've been in the COVID-19 recession, and now with the war going on with Russia and Putin, just when things were starting to pick up, boom, we go right back into a recession again. So what is an investor supposed to do when looking at recessions? Well, number one, you always have to look at what the news or what the online websites are saying about the DJIA and the SPX stock tickers. That is the Dow Jones Industrial Average and the S&P 500 index funds. These are generally used by investment professionals as the standard of the entire stock market because those are all of the best blue chip stocks in the whole stock market, the best of the best, the cream of the crop, and is generally considered a great way to measure overall stock performance of any stock, individual stock, or any mutual fund or ETF. So you always compare it against the DJIA and the SPX to see if you are doing good. However, during recessions like we're in now, you're going to find that the DJIA and the SPX are in the red zone. And so what to do about that? Well, a lot of people are seemingly counseled by financial advisors to hold on to these funds of theirs and just ride out the storm. I don't see any evidence of doing that in the Bible, though. Where does it say that? Where does it say that in the Bible? When I look at the Bible, I see Ecclesiastes 11:1 and 2, where Solomon is saying, invest in 8 business ventures in hopes that you might get a return because the day of disaster might come. Now, the day of disaster could be referenced to pestilence, famine, or a recession. Now, think about that. Ecclesiastes 11:1 and 2 for a moment. The objective is to invest in 8 businesses, I would say probably the equivalent of blue chip stocks today on the S&P 500 and Fortune 500. Invest in 8 businesses before the day of disaster. Get the green returns to come into your Roth IRA or your brokerage account. And then when the day of disaster comes, sell the investments so that they don't go into the red persistently and eat away at all of the returns that you were working so hard to get. That's capital preservation. That's a form of capital preservation. And to me, where I'm sitting at, it's easier for us to do that now that we have computers and websites, and we can monitor stock and mutual fund and ETF performance in real time. Now, I do not believe in market timing. I do not believe in day trading, and I do not believe in, looking at stock, stock charts moving on an hourly basis and then selling it if it moves like that's ridiculous. That's technical analysis, and most people don't need to be getting into that. It's a waste of time. But when there's a general, news stories going out and the websites are all saying that these funds are in the red and it's not going to be changing for a while, man, sell those funds, those individual stocks, those mutual funds, those ETFs, and turn them into unspent cash and just keep them in your Roth IRA. Don't play around with trying to get gains and returns during a recession. Unless, of course, you have some blue chip stocks, like some strong performing oil stocks like Devon Corporation or Occidental or something like that, and it's still producing green during the recession. Well, why not? Keep the stuff that's producing green, but it doesn't make any financial sense to hang on to persistently red investments in a IRA or a 401k during a recession. Because all that's doing is the same thing as what I was saying in my previous video about bonds fluctuating and going into the red and leaching money out of your green returns. Well, the same thing can happen with an individual stock that's red, a mutual fund that's red, and an ETF that's red. And this is often going to happen during economic recessions. It makes zero financial sense to hang on to those. And if your emotions are going, rear, 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 they're telling you something. Your emotions are trying to tell you something. Get rid of those red investments. They're not good for you. All right. That's your inner knower. That's telling you don't hang on to that. If it's making you full of anxiety and instability to be hanging on to a consistently red investment, and your financial advisor says, no, hold it for the 30-year long term. Why is he saying that? Because he gets a commission off of your purchase. So he might not be entirely forthright with you about whether or not it's good for you to hold that. So this is why it's good to do self-directed investing, guys, and not get into a full-service brokerage, because a lot of times, stock jobbers, as Daniel Devoe said, can be villains. And they only care that you're buying their products that they keep rattling off because they get commissions and fees and expenses off of those things. There's ulterior motives going on there. Okay, so during an economic recession, the financial advisor with integrity would direct you to sell the investments and hang on to your cash. Now, I don't mean turn it into actual physical dollar bills and throw it in your safe. I don't mean that. I mean cash in the sense of unspent money inside of your Roth IRA, unspent money inside of your 401k. There's no tax penalties for this, guys. Taxes come later. We're talking about changing the form that the money is inside of your retirement account. During a recession, you do not want to keep your money in consistently red investments. It doesn't matter if they're BRI investments. It doesn't matter if they're Timothy Plan. It doesn't matter if they're Inspire Investing. If you're in a recession and this thing has been red for 6 months to a year, sell that investment and hang on to your cash for better days. When that recession is over with, then go ahead and buy your favorite investments again. Once they all turn green, once the DJIA turns green, once the SPX turns green, and all your favorite BRI investments turn green. Now, the exception might be that you might have one or two blue chip stocks like DVN or OXY that's still green even during the recession. There's no reason to sell those. They're still producing some returns for you. But you want to get rid of all these red mutual funds, ETFs, and individual stocks during recessions, because they're not going to be able to keep up with what's going on. They're weaker, and therefore they should be disposed of. Now, this does not mean you dispose of them permanently throughout the entire 30-year investing process. This just means that you do not want to be hanging on to them during recessions, or God forbid, a depression. All right. Now, what is capital preservation? Well, simply put, capital preservation is what Scrooge McDuck does in his money vault. He has tons of gold coins and cash in a giant money vault that is not in the stock market. Okay, that's capital preservation. It's not being circulated on the stock market. So books like The Aftershock Investor, and I'm pretty sure I haven't gotten too much into David Wilkerson, but America's Last Call, God's Plan to Protect His People. These books tend to lean towards gold as a good capital preservation investment. More than that, though, cash. Unspent cash inside of your retirement account. You want to take those things out of red stocks, out of red funds, out of red ETFs, and just leave them sitting there as unspent cash until the recession picks up. and is over with. And then you can put them into to try to get some gains and returns out of because all the other funds and stuff have turned green again. And we're talking about persistently green, because every once in a while I'm not talking about a 1 day thing, right? I'm talking about like 1 month, 6 month is green, okay? Because stuff goes red every once in a while on a 1 day or even a 5 day basis. You shouldn't be thrown by stuff like that. But we're talking about the difference between something being red and green on a 3 month, a 6 month, or a 1 year basis. Okay, if it's getting back to normal like that, go ahead and put your money back in those funds because it's going to get you more gains and returns again. Like Ecclesiastes 11:1 says, it appears that the day of disaster, Ecclesiastes 11:2, is now over with, and so therefore you can go back to Ecclesiastes 11:1 and start investing in the ventures to get your returns. All right, but it makes zero sense to keep on doing Ecclesiastes 11:1 to get the returns while you're in Ecclesiastes 11:2, the day of disaster. It makes zero sense to do that. Solomon says that investing should be going on in times that are not in recessions, Ecclesiastes 11:1, and that capital preservation, holding the unspent money in cash, should be going on during the recessions, the day of disaster. Ecclesiastes 11:2. There's multiple ways to do this, but usually you would have to say unspent cash, gold and silver. Now, I would just say gold and cash. Unspent cash in your Roth IRA, unspent cash in a brokerage account, unspent cash in a CD, and maybe some gold coins that you've bought. Now, let's talk about gold coins. My philosophy on gold coins has changed throughout this video log. Currently, I agree with The Intelligent Investor. I agree with Larry Burkett, Investing for the Future. I agree with David Gantz, Investing in Precious Metals. And I think there's somebody else that also spoke to this. You don't want to invest in precious metals. You don't want to invest in gold coins any more than 5% of your annual investment amount. Okay, so let's say if you have $10,000 to invest 1 year, 5% of that is $500. So you don't want to invest, if you have a $10,000 to invest a year, you don't want to spend more than $500 of that on a gold coin. So basically what you would do is you would go to moneymetals.com and buy a half ounce maple leaf, Canadian maple leaf. And there's canisters that you can get to store these things and put them in your safe or put them in a safety deposit box. Larry Burkett says safety deposit box at the bank. I agree with that because you don't want some burglar coming in and stealing your coins or having to constantly look at them and think about them all the time. But it kind of gives me a sense of security knowing that now I've gone through all this stuff, that gold does not dramatically fluctuate. They say it's a volatile thing. It's not really volatile. I mean, not in this, I mean, over like a 5 and 10 year period, yeah. But in the sense of recessions, it does not volatilely change during recessions, especially in a bad direction. Usually it's actually in an upward direction, in a good direction during recessions. So gold is a good thing to have during recessions. Probably why Scrooge McDuck had so many gold coins in his money vault, because he had seen those times before. So it's good to have it. It'll make you feel good to know that you had bought an ounce or a half ounce gold maple leaf coin once a year next time you have a recession, because at this point you're just living on cash and gold. You're just sitting on cash and gold. Okay, so you don't have anything but unspent cash, maybe a couple of blue chips still producing green during the recession, in your IRA, in your 401k, and you have a couple of gold coins in the safety deposit box at the bank, maybe some silver coins. It's okay too, but it doesn't really make a whole lot of sense to buy silver coins if you're confining your precious metals budget to $500 or $1,000 a year. I mean, if you're going to confine it to that, just buy a gold coin because that's more valuable than silver is. Um, so uh, there you have it, guys. I mean, capital preservation is about not investing, really. I mean, it's investing to not invest. It's investing to hold. It's not what the financial advisors want you to do, actually. They don't like capital preservation. They like you to buy a whole bunch of investment products that they can get fees, commissions, and expenses off of, rain or shine. They're the ones who are going to tell you to hold, hold, hold. Why? Because assets under management. That's why. They want to maintain that brokerage account for you. And so they're not going to tell you to sell uh, your investments during a recession, even though it's completely eating away thousands and thousands of dollars out of your gains and returns. Why? Because they make money off of managing your accounts. So it's dishonest in that sense. If you want to be totally responsible with with your investment money, you need to do Ecclesiastes 11:1 and 2, which probably means you don't want to have a full service brokerage, some guy making investment decisions for you. Because what does Ecclesiastes 11:1 and 2 tell you? It tells you to make the investments, you to choose the stocks, you to hold the money during the day of disaster, not somebody else do it for you. Now, again, it's not to say that money managers aren't biblical, because we have money managers in Luke 19. But that was on a short-term basis. So I think that self-directed Roth IRAs are really the way to go as far as being able to make your own decisions, follow your conscience, have more peace of mind, have more peace of heart during economic recessions. You know, um, you can get to the point where you're talking about long-term investing for the retirement. You can get to the point where you thinking about that so much that you put outside of your mind the fact that recessions will happen during this 30-year period. You gotta factor that in. I mean, yeah, it's great and good that you've adopted the philosophy of putting a mutual fund or two into a Roth IRA. I mean, kudos on you that you've been able to draw that conclusion that that's a good long-term approach to saving for retirement and maxing out that Roth IRA, $6,000 a year. That's great. But in the next 30 years, how many recessions are going to happen, right? I'm 37 years old and I've lived through like 3 or 4 recessions. The only two that I've become cognizant of are the Great Recession of 2008 when I graduated, and this COVID-19 Russia recession we're in right now. But actually, my dad, when I was a little boy, lived through recessions as well. There was a 1987 recession. There was a dot-com bubble recession in the early 2000s. So right after the 9/11 happened. So I'm 37 years old and 4 recessions have happened already. I might be wrong on this. Look up recession history on Wikipedia or something. I'm pretty sure about that. 4 recessions have happened in the course of 40 years. That means at least one recession happens every 10 years. So if you're looking at a 30-year time span of saving for retirement, you can count on 3 more recessions to happen between now and the time you're 65. And if you're, if you're in my age group, if you're a millennial, I predict we will have at least 3 to 4 more recessions before we reach retirement age. Therefore, when your stocks, mutual funds, and ETFs go persistently red, I'm not talking on a 1-day or a 5-day basis. I'm talking on months and months, maybe even a year. It is persistently red. I would say if it's going for 2 months, sell it. You've lost enough money already. If the DJIA and the SPX is red, you've lost enough money already at that point. Sell it so you don't lose more, you know. And that's capital preservation, guys. You're not going to get capital gains tax off of doing that because you're not pulling it out of your Roth IRA. That's the only time you're going to get capital gains tax. Don't get afraid of a capital gains tax if you trade your funds. That's only going to happen if you pull funds out of the Roth IRA for use. Okay, but we're talking about stuff that's inside the Roth IRA, inside of another brokerage account, and you're just shifting the money around. You want to pull it out of red, persistently red things and just keep it as unspent cash until the recession is over. And also, let this be an encouragement to you. Shop around moneymetals.com. Don't go gung-ho. That would be bad and unadvisable according to conventional wisdom on moneymetals.com. I recommend buying $500 or $1,000 worth of a Canadian maple leaf a year. And that seems to agree with the guys that I've read, Burkett, and Jason Zweig, who comments on The Intelligent Investor, and some other guys I've read. You don't want to spend more than $500, maybe $1,000 on gold a year. Physical bullion gold. And you might say, that's not Bible times. Well, our economy has changed format. We're a very electronic economy. So they didn't have electronic money in the Bible. So most of currency and cash flow was through gold and silver back then, or animals. Today, 95% of our cash flow today is electronic. So it only makes sense for about 5% of our investment money to be in bullion at this point because of the highly electronic nature of our money. All right. So that's everything I have to say about capital preservation at this point. I will also say this. Some people like to refer on real estate as capital preservation. My current opinion on that is that don't do it. That's my current opinion. I have about 5 or 6 more books to read on investment yet, so I might change my mind on that. But if anybody knows a little bit about economic history, Great Depression, Great Recession, etc., real estate is extremely unreliable during recessions. So it might not be a good idea for capital preservation. I would stick to unspent cash in an account and the occasional gold coin. Don't go into land and lots and real estate. I mean, you're free to do that, but it's not what I would do. Because you want to put your money in stuff that has the least possibility of price fluctuation during a time of capital preservation. Riding out the storm, not circulating your money. And maybe this is one of the reasons why DJIA and SPX drops during recessions, because everybody is selling their shares of DJIA and SPX and hanging on to their money. They're pulling out of the stock market during recessions on massive scales. It does say on Investopedia to pull out of the stock market out of red investments during recession. So maybe it'd be interesting to know this on a survey basis. How many people pull out of the stock market during economic recessions? I'm sure there are millions of people that pull out of the stock market during recessions. I don't have any numbers at this point, but I'm sure that it is a very commonly done thing. It might not be a thing that investors and financial advisors tell you to do, but it might still be a thing that a lot of investors do, and might explain why stock markets crash during recessions, because everybody panics and pulls their money out. So anyway, some interesting thoughts. On a personal level, though, you don't want to be playing the stock market a whole lot during a recession. That's my final word on that. God bless you all out there. And my logic on that is Ecclesiastes 11:1 and 2. God bless. WesleyGospel.com.